Good morning. I'm Josh Steiner, Sector Head of Financials and Housing Research here at Hedgeye, and with me today is David Dunn. David is the president and founder of Kingsbridge Wealth Management. David has more than 2 decades of professional experience in investment management and wealth management. Before founding Kingsbridge in 2008, David was employed by Bear Stearns, Morgan Stanley, and Merrill Lynch. David's areas of expertise include investment management, tax planning, trust and estate planning, fiduciary services, and alternative investment strategies. And David has created and serves as the general partner of 5 private alternative investment funds. Today, we're going to be learning about a new product in the world of housing finance, the home equity contract. Before we get going, however, please allow me to read our disclaimer in terms of use. Hedgeye is not a broker-dealer and does not provide investment advice to individuals. This presentation does not constitute an offer to sell or a solicitation of an offer to buy any security or investment vehicle, and does not purport to sell or recommend any investment products or strategies. This presentation is for educational and informational purposes only and is made without regard for individual investment preferences or risk parameters, nor does it constitute or contain any legal or tax opinions. The opinions and conclusions contained in this presentation are those of the individual expressing those opinions. Hedgeye does not endorse and is not recommending any of the products or services offered by Kingsbridge Wealth Management, home equity contracts, or any other products or services discussed in this informational presentation. This presentation is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. There's a fee associated with access to this report and the information and materials presented during the event. Redistribution or republication of this report and its contents are strictly prohibited. By joining this call or possessing these materials, you agree to these terms. For more details, please refer to the appropriate sections of the Hedgeye Services Agreement and the Terms of Service at hedgeye.com/terms of service. If you have any questions, please email them to qa@hedgeye.com, and we'll be sure to answer them. I'd like to thank you, David, for joining me today. Without further ado, let me hand it off to you.
Well, thank you, Josh. Thanks for that introduction. It's very nice to be here with you today. Very excited to talk about home equity contracts. It's an area that we've been looking at since 2016, and we think it is a innovation in the home equity finance space. As you know, I've followed some of your research, and the residential real estate market's about a $32 trillion market. There's a very active $12 trillion debt side of the market, and this is a new form of financing that comes in as an equity alternative to debt financing for residential real estate. So with that in mind, I'll jump right into it. Since 2011, when the financial crisis kind of wound down, there's been a huge creation of home equity as home prices rebounded, and yet there's actually been a shrink in the debt market and shrinkage in the debt market, which means that homeowners are equity rich and house poor, basically. There's several people that have looked at this and tried to address it with a non-debt solution. One of the groups out of Silicon Valley that we've been working with since 2016 has come up with a home equity contract that is basically a way for homeowners to sell a portion of the equity in their home to an investor like Kingsbridge, and for them to get the liquidity and for giving us rights to participate in the future price appreciation of their home at a discounted purchase price. And that's basically the genesis of the contract. In the past, homeowners have had basically 3 alternatives. You can sell your home and move, access your home equity. You can take on additional debt with a cash-out refinance on your first mortgage, or you could take a second mortgage in the form of a home equity line of credit or home equity loan, basically. So we think this provides homeowners with additional financing strategies. I look at this from the sense that classically corporations have always had the opportunity to do an equity recapitalization where they're able to sell additional equity in their company and pay down debt and reduce debt burdens. I think this finally gives homeowners a chance to use the other side of the balance sheet also. The opportunity that we see really comes out of also what we're seeing is the data that's available on the housing market and the use of kind of data science and big data to be able to analyze and understand people's needs. And so basically we're paired with some fintech entrepreneurs who are out there finding homeowners that have substantial equity and then offering them this non-debt financial solution to access the equity without having to sell their house. They're looking at all types of all parts of the spectrum of the homeowners. We're looking for homes that we believe will appreciate, homeowners with substantial equity that can stay in their house and not come under financial strain. So that's basically what they're looking for. The entrepreneurs we're working with are venture-backed by some of the leading names in venture capital, and are attacking the problem with plenty of assets behind them. And we think that this is one of the things that really attracted to the space is that this is good for both the homeowner and the investor. So the homeowner gets needed liquidity, and the investor gets compensated for the risk they're taking for investing in the homeowner. And as home price appreciates, the homeowner continues to participate in the growth of the price of their house, and the investor goes right along with them. The interests are aligned. If the homeowner wins, the investor wins. If the homeowner loses, the investor loses. So that's another part that we really like about it. And we like to do investments at Kingsbridge where we know where our capital is solving a problem, and we understand that problem, and we get adequately compensated for the risk we're taking. And we think that home equity contracts fits all three of those bills. We have found it extremely interesting what people do with the liquidity we provide. We thought when we first started this that we could kind of fit in certain buckets. People are way more innovative than we thought. About 50% of the people use it to reduce their debt burden. Some people use it simply to have cash reserves. They're tired of being cash poor. Life events such as divorce, medical expenses, education, investments. Some people are using it to buy additional real estate, maybe income producing real estate versus personal use real estate. Credit repair, and then a lot of people use it to actually renovate the home they're in. They basically say, if I could update the home when I do go to sell it, it'll be more valuable. We particularly like those because they're actually making our collateral more valuable. Great use of the capital. Let's talk a little bit about the landscape. There's multiple companies out there trying to address this issue, and they all have similar ideas that a non-debt solution would be useful to homeowners. The demand definitely seems to be in the marketplace. Currently, we're aware of 5 different originators that are originating these contracts. Each contract has a different flavor to it. Some contracts are very formulaic in that they believe you either qualify or you don't. It's kind of a on-off switch. Other contracts are priced based on the strength of the homeowner and the strength of the home and the property. Basically, what we've looked at is a system where the originator originates and services the contract for the life of the contract, and their payment is throughout the life of the contract, some up front from the homeowner, some from the investor along the life of the contract, and then some at the time of exit of the contract. We think that's really important coming from where we all saw in the financial crisis with basically mortgage originators not having any skin in the game. The originator stays in the game throughout the life of the contract. We've basically put a system together where we have the original documents custodied with a custodian similar to what you do with a mortgage, so very much using the mortgage rails that are already out there. And we've also insisted on having a sub-servicer to do any heavy lifting in case we have to enforce any liens or any other of the legal portions of the contract. The originators at this point are generally, I'd consider them fintech entrepreneurs, and so having a sub-servicer that's very experienced in the mortgage world and is familiar with with how that system works is very helpful. When you look at it originating, I mentioned it earlier, you're basically underwriting the home, and we're looking for homes that we believe are in areas that have strong home price appreciation. So at this point, this isn't available everywhere. We think that about, in the end, maybe 70% of the homes in America will have this available to them. And we're looking at homeowners that we're not underwriting debt, we're underwriting equity. So the main concern with underwriting the homeowner is, will they default on the debt which is senior to our equity? If the answer to that is no, then we're pretty comfortable with purchasing the equity if it's a home we'd want to partner with. What determines the risk level of someone on default is a little bit up for debate. Different originators have a different view on that. Some of them use very traditional Fannie, Freddie underwriting guidelines on the homeowner, and they go, from start to finish across everything from debt to income ratios to FICO scores to reserves. And some people simply say there's a few things that we believe are the true tells of whether someone's at risk for a default or not, and they look at it as a very binary outcome. Either you have a elevated risk level or you don't. Most of the homeowners we're looking at, we believe, and the originators believe, that there's less than a 2% chance that they're going to default on their senior debt to us. And the data really shows that that's true. We're dealing with people that, and we should start with this a little earlier, that have generally a minimum of 50% equity in their home. It goes down to maybe 40 or 30, but the majority of the cases you're going to start with 50% equity in the home. What we really like about the actual contracts is that it's not a direct equity investment. It's more preferred equity or an equity option. It's been described as both, but we have a protected downside as an investor, and we have an accelerated upside. So if, I always use the example, if it's $1 million home, you have $500,000 in equity, we're going to buy 10% of that home for $100,000. But for that, we're going to get, say, 30% of the appreciation in the home above a discount to the $1 million, so maybe above $800,000. So we have the accelerated upside participation, and we have a 20% protection on the downside. That's fairly typical of the type of contract that we invest in. The homeowner obviously benefits because they get liquidity. It's not debt on their balance sheet, and they've basically sold future price appreciation in their home to access capital today. We look at, from the return spectrum, what kind of returns we expect on that, and it looks, from our experience, that the investor is well compensated for taking equity risk with homeowners. We do look at these contracts and say, what does it take to, the contracts generally have a max IRR component that was added a little later in the process, but realistically that came out of the fact that we want to make sure that it's fair to homeowners. And then with the protected downside, in most cases we have, say, anywhere from 15 to 28% downside protection for short-term home price fluctuations. And it generally takes a pretty catastrophic event for us to lose our equity investment. In most cases, it's somewhere down around more than 40% down on the home, somewhere between 40 and 50%. One of the things we always model when we look at this, when we're looking at your home, we're trying to determine, is this a home we want to be an investor in, is we're going to run a stress test on how home prices in your area did during the financial crisis.
Sure.
We look at the HPI from Case-Shiller and say that from peak to trough it was about a 27% decline. That's a little bit of how we price that discount on where we want to buy in the home at, and we're looking to make sure that a short-term price fluctuation doesn't result in us taking a loss. And one thing I would like to point out, though, is that I've seen some of your housing data. It's very, very diligent data, and home sales go down when home prices go down. So people don't put their home on the market. When we look at it, we want to partner with people at 50% equity. If you tell them their house is worth 25% less, the majority of those people we feel are going to hold. With that said, one of the things we really like about investing directly in Main Street is that homeowners are not necessarily rational nor optimal, and they're literally going to live their lives. If they get a job offer, if they move, if they have family issues, there's many reasons why people relocate, and they may take us out way earlier in the contract than what people would expect. I always equate this to the 30-year mortgage is priced on the 10-year Treasury, and the average duration seems to be somewhere in the 7-year range. We write 10-year contracts at this point. In the future, we'll probably invest in 15 and 20 and 30-year contracts, but the duration is definitely less than the actual term of the contract. One of the things we look at, and we've looked at as part of our process of looking at both the upside and the downside of investing in people's homes, is rolling 10-year periods where home prices have gone down and stayed down. Our research basically shows that the only period we can find where that's the case is really the Great Depression. Even the financial crisis didn't have 10-year periods that had substantial loss in home prices. So we think from that side, it fits our criteria. We really, we believe in the homeowner. Most of us are homeowners. We've been in, we feel like we understand the psychology behind home ownership. And a couple of things we look at is that generally after our contract, they still have about 40% equity in the house. And we do think that homeowners are going to do what's in their best interest, and we're happy to be an investor in them and their home because their best interest is our best interest.
Great. Well, let's, so I think that's a great overview. Let's maybe dig in a little bit. Talk to me about, the size and sort of scope of the opportunity that you see over time.
So there's it's a little hard to assess because we see what the potential demand is. We think that's around $3 trillion. That's a number that we've looked at from kind of tappable equity, people who do research for the mortgage industry. Those are people with at least 50% equity in their home. It's some fraction of that. We need two things from the homeowner. We need them to have substantial equity. Their home needs to be an area that we want to invest in, and they need to be seeking liquidity. So it's very hard to say how much of the $3 trillion is seeking liquidity. I can tell you how the originators target that. They are looking at soft pull data from credit sources to see who has rising credit card debt, who is applying for more, maybe home equity lines of credit and other things, and then they're looking to reach out to those people and provide them with an additional financial solution that's non-debt.
Yeah, the numbers are kind of staggering, which is part of the reason that I was really interested in having you on and learning more about what you guys are doing, because I was looking at some of the numbers today. Right now, total commercial real estate residential exposure is about $2.3 trillion. And if you look at just the home equity line of credit component, it basically went from $100 billion around 2000 up to $600 billion right before the crisis. And it's really come down to about $350 billion today. And so to me, what that sort of speaks to is just that underwriting standards post the crisis remain extremely tight. It's still a lot more difficult than it was pre-crisis to obtain home equity through really any channel, even if you want to. And so that's what I thought was sort of so interesting about this was, it's just really a radical approach. And the analog, we cover the real estate services companies like Realogy and Remax and Redfin, and their industry is sort of being chipped away on the margin by what's called this iBuying segment, which is companies like Opendoor and Zillow and Redfin Now and so forth, where they'll sort of buy your house on the spot as opposed to trying to sell it for you through a broker. And to me, what you guys are sort of doing is sort of the analog to that on the home equity front. It's just very disruptive and very interesting. And maybe you could sort of elaborate a little bit about some of these partners who you work with, and how'd you sort of come to be in business with them, and how do they see sort of the world evolving?
Yeah, so we were approached directly by what we believe is the leader in the space, a company out of Palo Alto called Point Digital Finance. They'll actually give a press release here in the next day or two. They just took in a Series B financing. These are venture-backed entrepreneurs, multiple times being successful entrepreneurs. They decided to address this problem basically on the experience of one of the founders, very similar. He went to borrow on a home he owned outright and was told that he did not qualify for a loan. For someone who just sold a company to a major U.S. corporation and he felt he was a pretty good bet, he found that fairly unbelievable. Yeah. And so he came up with the solution. We then actually, after getting involved in this, have sought out other originators, and we felt the opportunity was definitely big enough, similar to the mortgage world. There's tons of mortgage originators, that there would be multiple originators, and so we've gone out to every originator we could find and had conversations with them. Some of them fit our investment criteria, some of them do not. But there is several groups. We've identified 5 or so that are trying to address the space. Most of them have done the same type of research. They've looked at the big data. They've seen the same thing you have. Home equity lines have gone down in the same time that home equity has grown. So for one reason or another, and there's a little bit of debate on that, of whether it's underwriting standards. I've had some people push back on that and say, no, it's not it. That banks are loosening again. That's not what the numbers show. Yep. I think I looked at your slide last week and it said used to be 80 billion a quarter, or it's down to 10 or 20 billion a quarter. Correct. For whatever reason, people are not looking to lever up their homes. I personally, I get that. That resonates with me. I'm not a big fan of debt. I think it increases a lot of risk. And if you can access liquidity without debt, even though you may give up some future upside or dilute yourself in the sense of, a business sense when you sell additional equity, I think it's worth it not to have the strain of the debt burden, and I think that's what we're seeing. I can tell you, I just saw a slide today from one of our originators, and applications are skyrocketing. Interesting. The word is getting out. They're in 11 states, moving to 17 states. And as they try a combination of online advertising, targeting the specific homeowners as well as direct mail, more and more people are hearing about it. And as I go around speaking about it, a lot of people come out of the conversation saying, this would be perfect for my uncle, for my sister, for my brother. And how do we apply? How do we do this?
What are some of the differences? So there's sort of the front end, which are companies like Point, which you mentioned, and some others, and then there's sort of the back end, which are the providers of capital like yourselves. What are some of the differences in approach that are being taken both on the front end and on the back end?
So the way I describe it is that there's nuances to approach, similar to the way, if you think of the mortgage market, some people take a 30-year mortgage, some take a 15-year mortgage, some people take an ARM that's 5-year fixed to adjustable. A lot of these people, a lot of the originators. So we currently deal with Point out of Palo Alto and Home Tap out of Boston. Both very smart business, entrepreneurs, and they've looked at the same information and come to a slightly different answer. I always say they get to the answer is 5, but they get there with different math. It's 3 plus 2, it's 1 plus 4, it's however you do it. They're both trying to basically assess the home price appreciation of the home and the ability of the homeowner to stay in the home and not lose it to foreclosure. They go about pricing that differently. They're not far off, but it's a different set of math, which is, it's okay. From our standpoint, we've analyzed both contracts. We don't really have an opinion if one is better than the other. It's simply what resonates with the homeowner. I can tell you, although Home Tap is new to the marketplace, they're already competing out there. So a lot of these people are looking at contracts from multiple originators and making a decision, which I found that interesting. That is interesting. That you don't really realize that, but even in the early stages of what we consider to be, a new industry or a new financial instrument, there's already competition.
That's interesting. But one of the things that sort of intrinsically interesting to me about what you guys are doing is, there's this sort of emergent mentality, call it openness, on the part of sort of, let's say, millennial buyers at the sort of dawn of their adult lives, if you will, where obviously they're more tech savvy, they're more focused, they're more willing to do sort of unconventional things when it comes to all aspects of their life, as well as housing. And one thing that's interesting to me is that it seems to me like the people who are very equity rich right now are, of course, further along in life, but at some point in the future, 5, 10, 15 years from now, you're going to have this sort of conjunction of the people who would, I think, be sort of more naturally open and inclined to what it is you're doing, finally in a position where they are more equity rich. And so it just seems like maybe we're sort of headed down the path. Have you guys thought at all about sort of the mindset of different would-be people who would take advantage of your product?
Yeah, actually, we've had internal debates about this nonstop. But originally, some of the assumptions we had going into this of who would be the people that we'd be targeting were people who had paid down their home over longer periods of time, had been in the home a long period of time, were maybe a little older. That really has not necessarily been the case. A lot of people in both the baby boomer generation and the millennial generation are very much about their lifestyle. And as somebody who's been 26 years advising people on financial matters, I've come to the conclusion that cash flow is lifestyle. The more cash you have available to you to live life the way you want, to travel, to dine, to purchase things, is basically your lifestyle. People will protect their lifestyle at all costs, and we've seen that generally with the use of leverage in credit card debt, in lending club loans or anything like that. And to give people access to an equity asset they have without debt, I think many people are open to that, and they're very protective of their lifestyles. They do not want to put more debt on themselves and lower their available spend. And so we see that many people literally put a lot of money down on the house so that they could comfortably afford to live there. The house grew, and they wish they could have some of that back. They'd rather have it in the bank, they'd rather have cash reserves, they'd rather pay down other debt that is basically cramping their cash flow and their lifestyle.
Well, that's kind of one of the interesting things about it from sort of a structure standpoint, is that you're basically in a setup where people are sort of amortizing down, right, their principal obligations. So whether they're in a 30 or preferably a 15-year mortgage, and they're sort of chipping away at the principal over the duration of the equity participation. And then I guess conversely, the point you just brought up is that in some cases people are using it almost as a form of debt consolidation in some ways. So it's sort of a nice setup, it seems like, where the risk profile of the investment clearly goes down over time.
So one of the things that we came to after actually a couple of years of owning these and really getting into analyzing, and we've had 50 exits of the contracts we've owned and been involved in. And some of the assumptions we had in the beginning actually did not play out. But one thing we realized is that the longer the contract is out there, the lower risk the contract is for us, because the position we're in generally is a second or a third lien, and they cannot put any liens above us. So technically, if they could find a lender who would lend them money on their house who would be junior to an equity lien, I don't think any lenders would ever take that bet. They could do that, but they're paying down the debt over time, and our collateral is getting basically better and better over time. We like that portion of the investment also. Like I said, there's many things about the contract we like, and about the fact that we're really a partner with the homeowner. The other thing I like is there's not a lot of financial engineering at this point here. It's a new product, and there's the originator, and then there's us as the investor. It hasn't been securitized yet. There's not 3 or 4 levels of financial engineering on top of it, and at this point, it's as close as you can get to a direct investment at Wall Street, and Main Street.
So Just geographically, I was looking at some of your slides earlier, and it seemed like you had exposures in California and I think in the Pacific Northwest and also on the East Coast. Sort of talk about maybe the markets that, what are the profiles of the markets that you guys sort of think about, or is it more a function of the front end, the originator? Or?
So it's really the originator that we're tasking with that. I mean, we've all looked and seen what the top 50 MSAs are in the United States. I think that's probably the initial target markets. Right now, a lot of this started in California. California has had a lot of home price appreciation. And Southern California, we really view as a different market than Northern California. Then you have Oregon, Washington, Colorado. And when we stress test all these, we were very impressed when you go to stress test a Colorado home. If you look at the MSA level, they basically did not participate in the financial crisis. The max 12-month drop was literally like 4%.
Interesting.
So there's different parts of the country where the economics are different. You move to the East Coast, Massachusetts, I believe Rhode Island, New York, New Jersey just rolled out, Virginia, Washington, D.C., and basically looks like they'll be in 30 states by the end of 2019, maybe first quarter 2020. And so it's going to be available in a state near you. There's some states where there is issues with it from basically a regulatory standpoint, that there's things that don't allow it. I know that most of the originators would love to be in Texas, but Texas has some laws on their books that simply don't allow this type of home financing.
Interesting. What do you think are the biggest sort of restrictors or governors right now to the industry sort of becoming bigger? Is it sort of advertising and sort of communicating to the customer on the front end, or is it availability of capital on the back end, or is it all of the above?
Well, I think the availability of capital is going to solve itself. We're one of the early adopters on this, but I think as we're able to build a successful portfolio of these contracts, that the word will get out. I'm sure there'll be pools of capital that are more than willing to come into the space. There's one of the originators who markets this to more of the pension endowment market, and they write a 30-year contract, and basically their pitch is that this is a inflation hedge. This will have some spread on inflation, but that home prices are positively correlated to inflation. Now, I've seen periods where that's not true, but long term they believe that's true, and that this is a great play for people who are looking to have a spread on inflation. And so there's different markets. I don't think capital is going to be the issue. I think the main issue right now is scaling. You're trying to create a business that goes from 25, 50 contracts a month to 500 contracts a month to 5,000 contracts a month to 50,000 contracts a month. So keeping that origination cost low and being able to really roll this out without losing the integrity of the contract from the investor standpoint, I think is going to be the challenge. I think there's some really strong entrepreneurial teams that are addressing this, and I'm pretty confident they will be able to do it. And probably multiple originators will scale.
Maybe talk a little bit about the environment where we're sort of coming from versus the environment where we're headed to, vis-a-vis sort of the last 10 years have basically been this sort of post-crisis environment, and so many markets have just been unbelievably strong from a home price standpoint. And presumably over the next 10 years, there's going to be plenty of opportunity, but maybe not quite as strong. How do you sort of think about that? And obviously you're sort of limited to a degree based on where the originators are sort of operating from a regional standpoint, but how do you guys think about that from a risk management standpoint?
So from the big picture economics of housing, I still think that we looked a lot, backward testing, and then we look forward and saying, I think that housing preferences will change, but I think housing will continue to grow. We really look at home price appreciation, I think, depending on which number you look at. historically has been around 5% per year, which is a pretty strong number. We look at our strategy and say that we only need it to be 3 or 4% for our strategy to be extremely successful. At 2%, we're reasonably successful. All those are acceptable outcomes to us, so we feel pretty good about that. The other thing that I see is that as preferences change, as people want to move, maybe they want to downsize, the baby boomers are downsized, the millennials are looking for first homes, Gen X, where I sit, is looking, this is maybe their upsize time or wherever they're at in life. Providing capital to the space, we are seeing a lot of renovations. We're seeing things like auxiliary dwelling units in California, where people are adding an apartment onto their house or their lot as a rental property. So we're really seeing it going to solve some of the housing issues. Obviously, I looked at some of your research, housing starts, housing stocks, the home builders, things like that. We really don't play into that. We're playing with the existing home market.
Sure.
And we think there's plenty of room in that market to improve on the existing homes.
Yeah, that's one of the interesting sort of trends is that the tenure of the average person living in their home has risen very significantly in the last 10 years. So people are staying put a lot longer. And it's sort of ameliorating slightly on the margin, but it's still very much true that inventory of existing homes for sale has been at or near record lows now for years. And so one of the, we've read a fair amount about this, and one of the interesting sort of dynamics is that, you end up sort of almost self-reinforcing that mentality where it's like, well, I'd like to sell my house, but there's nowhere I can sort of move to because there's nothing available. And so as a result, what I choose to do instead is basically put on an additional bedroom or bathroom or, renovate.
A new kitchen, the remodel, the updating.
It seems like, I think there's this sort of sort of curve where people have to kind of wrap their head around this idea of, doing things in a non-debt vehicle. But, once they sort of get over that, it just seems like this is going to be an enormous category over time. So.
Yeah, one of the assumptions that a lot of people, when we explain the strategy, have is that the exit is a sale. The data we have on our 50 exits shows 35% of the time that was the case. 60% of the time it was a refinance. And basically 65% the time is a refinance. And then there's about 5% of the time where people paid us off from savings or from a liquidity event they were just waiting for. So they've used the equity as bridge financing in that sense, or they've simply refied us out at the time where they can extend duration and get a new loan that would have the same payment that would not affect their cash flow. So buying the time and living in a nicer home for that time, or reducing your debt burden, or paying for your child's education, getting rid of those medical bills, all these things we see is very rational and healthy behavior by the homeowner. And the one thing I didn't say that I normally say, and the statistics a little hard to get to, but for the percentage of the U.S. population that is not the investor class, where their number one asset is not their 401k or their investment portfolio, home equity is the number one asset on their balance sheet. So for roughly 2/3 of America, if they write a personal balance sheet, the number one asset is their home equity. And so giving them a chance to access that equity without selling the house. And we go back to the cost. You mentioned the iBuyers. I've seen numbers anywhere from 6 to 8% transaction costs on average throughout the United States, depending where you are, to sell your home. So you're losing a substantial amount of your equity if you do exit in a sale. Refinancing, of course, anytime that you add additional leverage, you add additional risk. That's a cash flow burden you have to make, and it increases the debt burden you have. So we think it's obviously a great solution. We're very excited about it.
Yeah, well, Redfin was saying on their call the other day that in some cases they're actually going now down to as little as 90 cents on the dollar for iBuying to take people out. So more to your point. So do you think we'll see sort of these front-end companies come to market at some point in the future as public companies, or are we still 5 years, 10 years away from that?
So if I have to guess, I think some of the traditional mortgage players, some of the large players in that space, will probably want to become buyers once they go to full scale. That's my just a personal guess. They're very interested. They're watching. All of the originators have had very high-level meetings with some of the largest money center banks in the United States, who are very big in the mortgage market. And I think they look at this as an additional tool that they could bolt on to their mortgage origination platform that would simply give homeowners, you can take option A, you can take option B, you know, and they have the infrastructure to do that nationwide.
That's interesting. That's exactly what Realogy and Redfin are doing. When they bring in a customer, they present them with option A, we sell your house for you, and option B, we buy your house from you. And you can compare and contrast them side by side, and that makes a ton of sense. What do you think are some of the biggest challenges and risks as you think about things over the next 5 years, 10 years for your for what you guys are doing, and maybe also on the front end?
I think that on the front end there is, with anything new, we find that regulation is always a risk. There has been, the originators have all had random inquiries from different states. Used to be that we all believed that for a state regulatory body to inquire against your company, someone had to make a complaint or had to be brought to their attention. What I'm hearing from the originators is that's not the case, that the states are basically trolling and looking for companies that are active in their states, and then inquiring and looking of whether or not they can regulate them. It seems fairly aggressive, but unfortunately that's the mindset of some states, and so far it has not been an issue. It's been pretty clear this is not debt, so it does not fall under lending for state, and it really is a principal transaction, and the homeowner is welcome to sell a portion of their equity to an investor. So I worry about that slightly. When this was discussed by one of the originators, and this is obviously I'm hearing this third party, with groups like the Consumer Fair Protection Board, that they felt that the particular class, meaning homeowners with 50% equity, were not necessarily an at-risk class, and that these people had substantial assets and could make their own decisions on their financing options. So that's all positive, but in the back of my mind, I still worry about that slightly.
Fair enough. So you mentioned regulators. One of the things, when I first heard about this, and I heard a very sort of general description of it without actually really understanding what it was, but the first thing that popped into my mind was reverse mortgages.
Right.
How are you guys different than a reverse mortgage structure?
So that's a common question. I have to tell you, I don't claim to be an expert in reverse mortgages. I've done a fair amount of research to try to answer that question. My understanding of reverse mortgages, it's a debt instrument where the interest payments are deferred and simply accumulate on the back of the loan. The longer that loan's out there, the more that debt compounds and the interest compounds. You're paying interest on previous interest as well as the principal, and it just keeps going until the homeowner either moves out of the house, at which time the home is sold, or the homeowner passes away. It's only available to people 62 or above in most states. Some states it's 65. It is regulated, the government's involved, and you know, it is a particular tool that some people could use. I think that the headline number cost on a reverse mortgage these days is about 5%, but I think when you really do the math on that and run out about how long you might be in your house, and when you start paying interest on the interest you didn't pay, those costs are going to be fairly substantial. So I think it's kind of apples to oranges in that sense. In the home equity contract, if your home does not appreciate, once the discount is kind of out of the picture, we're participating right alongside the homeowner in whether the home goes up or down. So in the first few years, the discount plays a substantial role in protecting us as investors. In beyond 2.5 years, if there's no home price appreciation, it's we're going to feel any pain the homeowner feels.
You mentioned, I think, that there was a max IRR component in what you guys are doing. Maybe you could sort of walk us through what IRRs are typical in the industry, and maybe what you target, and what is a max IRR?
So because of the discounting mechanism in purchasing in at a lower price, on day 2 of the contract, or if you looked at it as an option, there is an in-the-money portion. In order to be equitable with the homeowner, instead of that number could be a large number. We've had some people do this for as little as 30 days. And then the sale they were waiting for on a commercial property or whatever it was came through, and they took us out. So instead of taking a huge embedded gain in that, the originators, 2 of the originators we've dealt with, there's another originator we know of who does not have a max IRR. They literally let the contract run without it. But the other originators came to the same conclusion, saying that we want to cap it. Basically, it's looking to cap in high to mid-teens. And the other idea was that, so when homeowners are comparing this and looking at other debt, which I think a lot of people involved in mortgage markets don't get this, is people may have a mortgage, but they also may have a balance on their American Express card at 29.9%. And they may have a lending club loan at 18.4%, or a credit union, consumer loan at 13%. So homeowners have multiple debts on the balance sheet usually, and they're not just comparing it to an actual mortgage. They're looking at a cost of capital for everything they do. But yeah, so the target is, you've asked the question, mid-teens returns, gross. For our investors, we target net double-digit returns. We try to basically under promise and outperform. So we think that it'll be slightly higher than the low teens, but we want to make sure that we're talking about through a full cycle. Like I said, I did follow your research for first quarter. Everyone seems to be calling the end of the housing market, and we just don't see that. But if the housing market were to have a short-term, home price depreciation, that's not necessarily a bad thing for us. We continue to buy in on a monthly basis into people's homes, and we're simply buying in at lower prices.
So I was looking at your pie chart on slide 8.
Yeah.
So are these the numbers that actually correspond to what people are using the capital for?
Correct. So that's our experience of, approximately 250 contracts that we've been involved in, and those are the actual numbers of what they use it for.
It's interesting because you got 51% using it for debt reduction, and then a further 13 for renovations. So almost two out of three people are essentially improving either their personal financial situation or the collateral value of the asset.
They're becoming stronger homes or stronger homeowners. We love both of those things. That's what I mean when we say investing in Main Street. We truly are investing in people. They're going to use the capital to make their lives better. And as an investor, we're excited about that. There's many trading strategies out there, things like that, where I'm not quite sure what's going on with our capital. We know exactly where our capital is going.
I thought it was interesting on slide 15, this chart that shows the rolling 10-year home price change. And it's interesting to me because I'd never actually seen it before. And I've looked at many charts of home prices over the years. And what struck me was how de minimis the drawdown from
the financial crisis.
The crisis was. And it sort of struck me that on a rolling 10-year basis, if that's sort of as bad as it can get outside of a Great Depression environment, it just seems indeed like a very asymmetrical setup from a risk standpoint.
And that's one of the things we like about it. We have to thank HomeTap for that chart. That's a chart that they did the research on. But when I saw it, I said, "Hey, this shows what we saw, but in a more graphical way." And the truth is that home price appreciation has been strong in our country, and I don't see any reason for it not to continue at some level. I'm not one of those guys out there. One of the originators who we do not do business with told us they're only going to pick homes that go up 6% per year. I kind of chuckled at that because I just don't think that's not reality either. Right. But the chart actually doesn't say that. There are some homes that have gone up 6 to 7% per year for quite a while.
For sure.
But that's not part of our strategy. We're really looking for just reasonable home price appreciation, which we kind of peg at 3%.
So in terms of the number of companies operating in this space, on the front end, you've listed 5 companies on slide 10. And then on the back end, of course, there's you guys. But sort of how many companies are operating overall in the space? And maybe just give us some semblance of how big is the space now.
So I don't want to jump in front of Point's press release, but you'll watch for that next day or so. There is at least one other institutional buyer who has come in with, it's already been announced, it's a $150 million forward flow agreement with Point also. The other originators, when you look at them, Unison is, and I'm only getting what I'm reading off their website, but they appear to have either a pension or endowment that has funded them. I think I read somewhere in the $1 billion range. They write a different type of contract. It's a 30-year contract. It's more symmetrical in that the appreciation up is the same as it is down, and it really is a play on an inflation hedge. And they seem to have a market for that. Barristone is similar contracts to Point and HomeTap's. And so I think that there's room for different versions. Capital's been a little slow to come in. I have my own theories on that. I've been here in town, out talking to people about raising capital for our efforts, and people seem real excited, but they want to write bigger checks. We're buying these contracts at $100,000 a contract, sure. And so we're basically building the portfolio $100,000 at a time. It takes a while to build, and it takes some patience. I think once we get to scale, there'll be many more pools of capital that are interested in investing in it. The attributes are hard to find. I don't have any other investments in my purview that have the same attributes as home equity contracts.
Yeah, well, I think the reason I wanted to have you on is because I think I see things maybe the same way you do, which is that this is a very intuitive, logical product that makes a lot of sense. And again, we're talking about just a massive market, and people are going to sort of evolve their way of thinking about things over time. And I think increasingly come around to this is a very competitive option with the alternative, which is debt. So with that, let me say thank you to everybody for participating. We look forward to having you on for future calls, and enjoy the rest of your day.
Thanks, Josh.
Thanks.